In 2021, while much of the world was stuck indoors, a highly specific digital market suddenly exploded, reaching an absolute peak of $17.6 billion in trading volume. This chart shows the entire lifespan of that market. It peaked in the winter of 2021, and then, almost immediately, 95% of that value evaporated. It is easy to look back at the millions of dollars spent on cartoon apes as a temporary moment of cultural insanity, but that misses the actual lesson. To see why a market of this size failed so completely, we have to look past the digital art. What remains is a perfect, isolated laboratory for studying the mechanics of a financial bubble. Historically, digital art possessed zero inherent scarcity. Because any file can be copied perfectly and infinitely, a digital painting lacked the one characteristic required for a high-value market: rarity. In May of 2014, a tech entrepreneur and an artist attempted to fix this. At a New York City hackathon, they designed a way to digitize works of art while ensuring the creator could maintain control over the original. They developed a system where a digital file is tied to a secure digital ledger called a blockchain. The ledger produces a non-fungible token, a unique digital certificate of authenticity that acts as a permanent record of ownership. While millions of people can still download, screenshot, or view the image for free, the ledger identifies one specific user as the verifiable owner of that unique digital deed. Early adopters use this to help creators. By automating secondary royalties into the ledger, artists began seeing life-changing wealth. One 18-year-old designer sold a single cartoon that cleared his family's entire mortgage and car debt. The creators built a system to help artists gain financial independence. But when the general public realized these digital deeds could be traded for a profit, they turned a technological tool into a speculative commodity. By early 2021, the conditions for a market explosion were in place. People were home with limited entertainment options, and government stimulus checks were flooding into bank accounts, providing a new wave of capital for retail speculators. The boom officially ignited in March when Christie's auction house sold a single digital file by an artist named Beeple for $69.3 million. High-profile influencers and celebrities quickly entered the space. Talk show hosts began displaying their cartoon avatars on national television, while musicians and athletes paid hundreds of thousands of dollars for their own tokens. Ownership of a digital ape became a signal of status in a new elite digital community. This influx of money was driven by the greater fool theory. Buyers were paying astronomical prices, not for the art itself, but because they believed the market momentum would allow them to sell to someone else for an even higher price tomorrow. The market had detached from the value of the art. It functioned entirely on the shared assumption that the prices would continue to rise forever. As the market grew toward that $17 billion peak, the data suggested a level of demand that simply wasn't real. Demand was often fabricated through wash trading. This involves a single user operating two different anonymous wallets and selling a token to themselves. By passing the same asset back and forth at higher and higher prices, they create a public record of increasing value. On certain major platforms, wash trading accounted for up to 95% of the reported volume. The market looked enormous, but the vast majority of that activity was an illusion created by a small group of manipulators. A 2018 experiment highlighted a limitation of this technology. A developer successfully verified himself as the owner of the Mona Lisa on a blockchain art certifier. The ledger recorded his ownership perfectly, even though the physical painting remained in the Louvre. It proved that a digital record only carries weight if the rest of society agrees to respect it. Once the hype cycle exhausted itself and people stopped agreeing that these receipts were valuable, the fabricated foundations of the market began to fail. The bubble deflated rapidly. By May of 2022, daily sales had dropped 92% from their peak. Active wallets plummeted, and the collectors who had intended to flip their assets for a profit found themselves with no one left to sell to. Celebrity-backed assets saw catastrophic losses. One prominent token purchased for $1.3 million by Justin Bieber was later valued at approximately $12,000, a loss of over 99%. Institutional support vanished as quickly as it had arrived. Auction houses closed their digital art departments, brands shut down their virtual projects, and the celebrities who promoted these assets began facing multi-million-dollar lawsuits from out-of-pocket investors. The retail investors who bought into the mania were left with illiquid digital receipts. Their value didn't fall because the technology failed, but because the collective market was no longer willing to pay for them. While the consumer market for cartoon images died, the ledger technology itself did not. Major financial firms recognized a use for the blockchain that had nothing to do with social consensus or digital status. This is real-world asset tokenization. Unlike the earlier bubble, this application involves digitizing assets with independent, tangible value, like property, private credit, and gold. By using the ledger to track these items, institutions can settle trades faster and reduce administrative costs. This sector has scaled quietly and rapidly. By the third quarter of 2025, tokenized assets crossed $30 billion, with major players like BlackRock and Franklin Templeton actively using the technology to manage institutional portfolios. The 2021 bubble is a case study in how greed can inflate a new technology into a destructive mirage. It raises questions about other emerging fields today, like AI, where hundreds of billions are being spent on the promise of future value. While the market for digital images collapsed, the ledger has remained. It is no longer a tool for trading JPEGs, but a functional system for processing high-value institutional trades.